Hello there, I hope that you are doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on DPD arrays. Now before we dive into this lecture, I first want to share with you the following. I understand that many of you have probably already researched the majority of these PD arrays in great detail. Meaning you have probably gone into your charts and you've probably investigated breakers and value gaps and such. However, during this lecture, I want to share with you a different perspective on PD arrays in general. And therefore, I ask you to go into this lecture with an open mind. Meaning, please understand that the PD arrays as they were taught by ICT are a representation of a certain logic. Because simply looking for these price patterns themselves within the markets is not enough. They can only be looked for within a particular framework. And that is why I'm discussing them now in the beginning of this 2025 model series. Here you can see the matrix of PD arrays. This matrix was originally created by ICT, the inner circle trader, and therefore full credit goes out to him for creating these PD arrays. Before we dive into this schematic right here, I first want you to understand the definition behind PD arrays. PD arrays are algorithmic signatures within the delivery of price. Meaning, throughout the delivery of price within buy or sell programs, what will happen is that IPDA will leave behind footsteps. Our job is to recognize what these footsteps are to anticipate what the next delivery function is likely going to be. When we pay attention to this matrix of the PD arrays, what you can see is that within this larger box, which represents a range, what you can see is that there is a premium side and a discount side. What this basically means is that above 50%, you can see that there's a red box which represents the premium side, and below 50%, there's a discount which represents the discount side. What you can see is that when we pay attention to the premium side first, that it begins with an old high or low. Then we see the rejection block form, then we see the bearish order block form, then we see the fair value gap form, then we see a liquidity void form. We'll get to the liquidity void in a bit because in my opinion you do not need to pay attention to it. Next to that you can see a bearish breaker form, and next to that you can see a bearish mitigation block form. If we pay attention to the discount side then, what you can see is that it begins on the lower end right here with an old lower high, a rejection block forms then a bullish order block, then a fair value gap, then a liquidity void. Again, this can be ignored, but we'll get to that in a bit. Then a bullish breaker forms, and then a bullish mitigation block forms. Now, when you pay attention to the way that I'm describing this matrix of the PD arrays, what you can understand is that I'm explaining a specific sequence to you. Meaning, whenever a buy or sell program is in, what you will see take place is that these PD arrays will form within that sequence. Meaning, first the rejection block will form, then the order block, then the fair value gap, then the breaker or mitigation block. When you start investigating this by itself, you're already going to look at PD arrays from a completely different perspective, because all of a sudden you begin to look at them from a sequence perspective. Meaning the sequence has to be in play in order to anticipate what the next delivery function is likely going to be. When a lot of people got introduced to any PD array, such as for example a fair value gap, what they initially think is that they should just go out there and trade every single fair value gap that appears. However, the fair value gap itself is simply a price pattern. The logic which I'm explaining to you now is not based around any price patterns, meaning it's based around understanding A to B, buy or sell program. Are we bullish or bearish? Because once that is defined, you can utilize any of these PD arrays to get into a potential trade. Now, when we pay attention to the liquidity void then, what you can see is that I mentioned already prior that you can kind of ignore this. And the reason why is because the liquidity void is basically multiple imbalances forming after each other. Or in other words, multiple fair value gaps forming after each other in a row, and the range of the liquidity void is those multiple imbalances. So for this lecture, we're just going to focus on the fair value gap. Now, what I will do with you is I will walk you through all of these specific PD arrays. I'm going to explain the logic behind them. I will first discuss all the premium arrays with you, and then we're going to take a look at the discount arrays. The sequence of the premium arrays begins with the formation of a bearish rejection block. A bearish rejection block forms when price forms a swing high with a long wick and trades into the wick before rejecting it and drawing lower. The range of the rejection block is the difference between the open or close of the final candle of the swing high formation to the high. Meaning inside of this example, what you can see is that price expanded higher and we saw the market eventually form this long wick, and the range of the rejection block is the price range between this candle's close to the high of this candle. Now please keep in mind that because this is an up close candle, we pay attention to the close to the high, its respective range. The range is the bearish rejection block. If this candle would be a down close candle and we would see open high, then the rejection block would be the difference between the opening price and the price of this candle's high. This is our bearish rejection block. When we pay attention to a chart example, what you can see is that the market formed this high right here, and we then saw the market deliver towards the downside. Eventually the market expanded towards the upside, and what you can see is that we took out that old high. Pay attention to what is resting above this high. Above this high, buy-side liquidity is resting. So what you must understand is that buy-side liquidity is being taken out, and we begin to see the signs of a swing high formation taking place right here. Do you see how this down close candle right here has a very long wick between the open of this down close candle and the high of this candle? The range between these two reference points is your bearish rejection block. And what you can now monitor moving forward is whether or not this rejection block is going to function as resistance on price. Now, for many of you, you might be wondering, okay, how do I know that the high is in? How do I know that the smart money reversal is in? How do I know that it's now going to turn around and draw towards sell-side liquidity? When it comes to your entry patterns, you must understand that the majority of you are going to enter way later within the PD array matrix. Meaning your focus should be on fair value gaps or breakers and mitigation block entries. There are methods for entering at the absolute high or low when it comes to any reversal which is taking place. However, when it comes to the highest probability trading setups and the most easy ones to spot, you must focus on fair value gaps and breakers or mitigation blocks. And that is what I would teach you within this model series. And don't worry, some of you are so motivated to get to that level of understanding where I can see these swing highs or swing lows formations before they form, and you want to enter at the absolute highs and absolute lows. So I will give some insights on how to anticipate those swing highs and swing lows formations as well throughout this series, but you must first understand the foundation. What you can monitor is that when this bearish rejection block forms, pay attention to what I outlined, that we took out buy-side liquidity. That's a crucial element, by the way. When this rejection block forms, what you're monitoring is whether or not we're going to reject it and whether or not you're going to see imbalances on the left side of the curve get displayed through, because that shows to you that order flow is changing from bullish to bearish. When we pay attention to the bearish order block then, this takes place when price runs higher into a point of interest, and the up-close candle or sequence of up-close candles that forms is your bearish order block. Meaning, the moment price crosses the open of the sequence of up-close candles or just the open of that first candle, the change in the state of delivery CSD is taking place. To play it safe, wait for the low of that sequence of up-close candles to be traded below. The reason why is because when you see the market displays below the low, which set up the repricing into the point of interest, from that moment in time, you can say with confidence, all right, we have likely formed a high and we're now going to turn around. The range of the bearish order block is from range low to range high, meaning from the lowest price level to the highest price level of that one up-close candle or sequence of up-close candles which repriced into your point of interest. When we pay attention to this example, what you can see is that there are 3 up-close candles which repriced into the point of interest. When the market reaches the point of interest, the reaction to that point of interest will be very telling moving forward. When the market rejects that point of interest and it displaces below the low of this first up-close candle, which set up that final run higher into your point of interest, and you see the signs present which confirm to you, alright, we're in fact turning around, for example, the creation of a rejection block as well, what you would then monitor is whether or not this sequence of upclose candles is going to function as resistance on price. Why? Because what's happening throughout this final run higher into your point of interest is the following. What's taking place is that manipulation is taking place. Buyers are stepping into the marketplace while smart money is being provided the opportunity to go short against those buyers. At the same time, buy-side liquidity is being taken out. Why? Because the market is expanding above old highs which are resting in the past. Therefore, what you're seeing taking place is that those buyers are being trapped into the marketplace while smart money is being provided the opportunity to fill their short orders. And this perspective is crucial to understand because it shows to you how we can look at manipulation. Because once we can recognize the manipulation, we can anticipate the distribution which will follow afterwards, as I taught within the previous lectures. When we pay attention to a chart example then, what you can see is that the market expanded towards the upside right here on the left side of the curve. Notice that the market was continuously expanding higher until it began to slow down. Notice that this high formed right here and the market then retraced. We saw this low form and the market had one more push higher. Notice the size of this upclose candle right here. This upclose candle took out buy-side liquidity resting above this high. The next candle opens high and then displaces towards the downside. Meaning, notice that we see the market trade below the low of this upclose candle right here, which is also the open. Notice that we see a CB form right here, which we'll get to in a bit. And we see the market retrace into this upclose candle. Now, when it comes to this upclose candle, what you must understand is that this upclose candle is a bearish order block. Why? Because we saw the market take out this buy-side liquidity right here. It reached a point of interest and we saw the market begin to displace towards the downside. From this moment in time, what you're monitoring is the reaction to this upclose candle. If the market is going to reject this upclose candle and is going to find resistance inside of that, that shows to you that order flow has changed from bullish to bearish. Meaning, the moment that the market traded below this upclose candle, a change in the state of delivery already took place. And therefore, what you can monitor is the following. You can monitor the price range of that upclose candle and specifically the reaction to 50% of this upclose candle. 50% of this upclose candle is what we refer to as mean threshold. If the market is in fact very bearish moving forward, what you will be monitoring is the reaction to 50% of the price range. As long as the market does not close above 50% of this price range, you're anticipating that we're in fact going to see the market reprice towards the downside heavily. And that is why 50% of this range of this upclose candle has to be monitored. Now let's say that instead of this just being one upclose candle, we would have seen multiple upclose candles. Then you could monitor the reaction to the full price range from low to high of that sequence of upclose candles. Because that sequence of upclose candles is your bearish order block. When we pay attention to the next premium rate then, what you can see is that we're going to be looking at the fair value gap. A fair value gap takes place when price expands into a one-sided direction in a quick manner without retracing to offer efficient delivery. This means price will seek to offer efficient delivery at a later moment in time. Why? Because its main function is to deliver price in an efficient manner on a time-based schedule. The fair value gap is the range between the first candle's low and the third candle's high. Meaning when we pay attention to this price pattern, what you can see is the following. What you can see is that there's a difference between the first candle's low right here and the third candle's high. Meaning there's a gap right here. There's a lack of buy-side delivery inside of the price range of this middle candle. Meaning if this third candle would have repriced all the way to the low of the first candle, then this price range would have been balanced out. But because that didn't occur, buy-side has to be delivered at a later moment in time to reprice back into that range to deliver efficiently inside of the price range. And I know I said it a lot, and some of you are probably like, okay, it's just a price pattern of a fair value gap. No, the logic goes way deeper than that. But for the majority of you, just looking for this fair value gap is more than enough. The fair value gap is the difference between the first candle's low and the third candle's high. When you start paying attention to where fair value gaps are forming, you are going to experience major light bulb moments. When we pay attention to a chart example, then what you can see is that inside of this example, the market was consolidating and eventually it slammed towards the downside with this big downward candle. Notice that the candle afterwards did not reprice into the low of the first candle. Therefore, there's a gap between the first candle's low and the third candle's high. This is what we refer to as a bearish fair value gap. What will have to take place is the following. What will have to take place is that the market will seek to retrace back into that price range before the market is allowed to expand towards the downside. When we pay attention to the bearish breaker then, the bearish breaker forms when a bullish order block sets up a run above buy-side liquidity, followed by displacement lower, causing the bullish order block to become an inverse bullish order block. Price will seek to retrace into the price range of the bearish breaker before expanding lower. What this basically means is the following. When the market expanded towards the upside and it retraced, and we then saw this low form, the market expanded higher once more, meaning this low set up the final expansion higher into a higher time frame point of interest, followed by a reversal which originated from that point of interest. When it comes to the delivery which takes place throughout this retracement lower, followed by the expansion higher, this is a fractal market maker buy model. And inside of this fractal of sell side and buy side delivery, you will see a down close candle form which set up the final run higher. This down close candle got utilized by smart money to buy off to target buy side liquidity resting above this high. The moment that the market displaces below this down close candle, so below this low right here, the final down close candle which formed right here is your bearish breaker. And that down close candle has to function as resistance on price in order for the order flow to remain bearish. Now, by what should this down close candle get displaced through? Ideally, we would like to see a bearish fair value gap form in this area as well. When we pay attention to a chart example then, what you can see is that the market formed this high right here, then dropped towards the downside. We saw this low form, and we then saw the market expand towards the upside, taking out the buy-side liquidity resting above this high. Notice that the market then repriced below that down close candle its low with this candle right here. Notice that we just wicked below it, and we then offered buy side back into that range to close it. Notice that the market then expanded away without having to retrace. Why? Because what's taking place right here is the following. We see sell side delivery through the low, and we then see buy side delivery back into the price range of the down close candle, and we then see the market leave this price range, and therefore it doesn't have to return. This means that this is now a lower time frame balanced price range, and therefore the market is now in a rush to expand towards the downside. More unbalanced price ranges will come later, because balanced price ranges are the reason why all PD arrays work. But in general terms for this lecture, I want you to focus on the price pattern of high, low, higher high, lower low. Pay attention to this full candle, this full down close candle, to gauge the order flow moving forward. Let's take a look at the bearish mitigation block. A bearish mitigation block forms when a bullish order block sets up a run higher, but does not, pay attention to the word use, does not take out buy-side liquidity followed by a displacement lower, causing the bullish order block to become an inverse bullish order block. Price will seek to retrace into the price range of the bearish mitigation block before expanding lower. The price pattern of a bearish mitigation block is very similar to the price pattern of that bearish breaker. The only difference is the following. The only difference is that the bearish mitigation block does not set up a run above the high before the low formation took place. Notice that the market expanded higher, but it formed a lower high relative to this high. Therefore, the moment that price trades below this low, we expect that this final down close candle is going to function as resistance on price, because it's going to function as a bearish mitigation block. Again, ideally we would like to see a bearish fair value gap form throughout this displacement leg towards the downside. When we pay attention to a chart example, what you can see is that the market formed this high right here. We then saw the market reprice towards the downside. Notice that this very large downward candle forms. And we see the market then reprice higher, consolidate for a while, and eventually it slams towards the downside. Notice, however, that before it slammed towards the downside and traded below this downward candle, we did not see this high getting taken out. Therefore, this downward candle becomes our bearish mitigation block, and we can anticipate that this bearish mitigation block is likely going to function as resistance price. Please keep in mind that it's the final downward candle before the run higher, which is your bearish breaker or bearish mitigation block. When we pay attention to the schematic of the PD array matrix then again, what you can see is that I've added the letters A on the top left and B on the bottom right. What these letters basically showcase to you is the following. What they show to you is what I outlined to you throughout the price cycles lecture, in which I outlined to you that every single price swing has an inception price and a terminus, an end price. Our job is to align ourselves with the delivery which is taking place between point A to point B. But when we pay attention to this PD array matrix, what you can see is that we can recognize when that move from point A to point B is taking place, when we recognize the sequence in which these arrays are forming, because each array is forming after each other. And that right there should be a major light bulb for the majority of you. Where instead of chasing patterns for the sake of chasing patterns, you're now beginning to understand that there's a certain order in which you can look for these patterns. And when all these patterns are forming in the right order, and you're trading within a bigger framework, and you're trading within, for example, a market maker sell model, then you know that you have a high probability short trade opportunity. We're now going to be paying attention to the discount arrays. And as outlined with the premium arrays as well, the discount arrays begin with the rejection block creation. A rejection block gets created when price forms a swing low with a long wick and price trades into the wick before rejecting it and drawing higher. The range of the rejection block is the difference between the open or close to the low. Meaning, inside this example, what you can see is that a swing low forms where you can see that there are 3 candles next to each other. Notice that the candle in the middle took out the low of the previous candle. Notice that the price range between the close of this candle to the wick, to the low, is annotated and highlighted by this white range right here. This wick is our bullish rejection block, and therefore, as long as price does not take out this low, we can anticipate that we're likely going to see the market begin to draw towards the upside soon. When we pay attention to a chart example, what you can see is that the market expanded towards the downside quickly right here on the left side of the curve, and eventually we saw the market stop right here. We engineered sell side and we saw the market retrace. The next candle then opened up, initially went higher slightly and then expanded lower. Notice, however, that the market then closed above the low which formed right here, and you can see that this very long wick formed. The reaction to this long wick will tell you whether or not order flow is changing. Meaning, what you can see is that this rejection block right here is functioning as support on price. And that tells you that you can now monitor whether or not the next discount arrays are going to get created. Therefore, the rejection block begins a new sequence. When we then pay attention to a bullish order block, we can see that a bullish order block takes place when price runs lower into a point of interest, and the down close candle or sequence of down close candles gets traded above. This sequence of down close candles inside of this example is your bullish order block. The moment that price crosses the open of the sequence of down close candles, or that one down close candle, the change in the state of delivery, CSD, is taking place. To play it safe and to confirm your CSD, I suggest waiting for the high of that sequence of down close candles to be traded above. The range of the bullish order block is from high to low, meaning from this high to this low. Pay attention to the fact that the bullish order block forms after the bullish rejection block has formed. When we pay attention to a chart example, what you can see is that the market formed this low right here, and we then saw it run higher. Consolidation took place, and the market then began expanding towards the downside. Notice that this low formed right in advance of the previous low, so we have two sell-side liquidity pools being engineered in close proximity to each other. We see the market retrace, and then we begin to see the market expand towards the downside. And notice how quickly it drops lower. Notice how quickly it reprices below this low. We see the market take out the sell-side liquidity resting below this low, and we eventually see it turn around and trade above the open of this down close candle. Now here comes a tip. Whenever the price range of the full bullish order block is rather large, meaning from this high to this low, what you can pay attention to is the range of purely the bodies, meaning you can ignore the wicks then. Why? Because the wicks do the damage whilst the bodies tell you the story. Therefore, you can see that within this chart example, I've annotated the open of this down close candle as the beginning of the bullish order block. What does that allow me to do? It allows me to have a better entry than where I would enter at the high of this down close candle. That should be a big light bulb moment for many of you. Notice that inside of this down close candle, we also see the market form a bullish fair value gap whilst we reprice through it. Pay attention to what happens to this bullish fair value gap, which we'll get to in a bit. This bullish fair value gap functions as support on price before the market eventually expands towards the upside. So as a general rule of thumb, whenever you see a large bullish order block form, pay attention to mainly the bodies. When the bullish order block isn't that large and it's a rather small order block, you can annotate the full range from low to high. When we pay attention to the fair value gap then, which I've already shown to you prior, the fair value gap forms on the bullish side when price expands into a one-sided direction in a quick manner without retracing to offer efficient delivery. This means that price will seek to offer efficient delivery at a later moment in time. The fair value gap is the range between the first candle's high and the third candle's low. When we pay attention to the chart example, what you can see is that the first candle reprices higher, the second candle then expands towards the upside quickly, and notice that the third candle opens up, initially drops lower, but does not reach the first candle's high. Therefore, there's a lack of sell-side delivery which is now present inside of this range when the market expands higher again throughout that third candle's formation. That means that there is a bullish fair value gap which has been created, and the market will seek to retrace into that bullish fair value gap before it's allowed to expand towards the upside. Now, there are scenarios in which these fair value gaps are allowed to stay open, but then we're speaking about breakaway gaps and they require a lecture by themselves in the future of this model series. Right now, your focus is on recognizing the pattern of the fair value gap. When we pay attention to the following chart example, what you can see is that the market expanded towards the upside quickly, and you can see that there is an imbalance which formed right here between these three candles right here, where I can see that this first candle's high and the third candle's low right here have a difference in between the two, and the reason why is because the candle in the middle expanded towards the upside significantly. Therefore, this range has to be monitored moving forward because this is your bullish fair value gap. When we pay attention to a bullish breaker formation then, you must understand that when a bearish order block sets up a run below sell-side liquidity, followed by displacement higher, a bearish order block will be turning into an inverse bearish order block. And the reason why this is happening is because just like I outlined to you within the bearish examples, within the premium rate creations, we're looking at that final run lower right here to be manipulation. What's happening here is the following. What's happening is that the market is dropping lower, sell-side liquidity gets engineered, a retracement higher takes place, and we then see the market drop lower one more time, taking out sell-side liquidity below this low, reaching a point of interest, and the moment that the market displaces above this high, we anticipate that the final up-close candle which formed throughout this final run lower, yes, or which set up this final run lower, I should much rather say, we anticipate that this up-close candle has to function as support on price, because this up-close candle is your bullish breaker. What will happen is that price will seek to retrace into the price range of the bullish breaker before expanding higher. And this is the entry opportunity which I will show to you throughout this model series, because once you start understanding when and where this setup presents itself, it's going to unlock a completely new perspective on all financial markets. Because this right here is, in my opinion, the most straightforward trading setup which you can look for. There are very clear rules which apply to it. It's not simply this price pattern of a bullish breaker, just like with any other of the previous PD arrays which I've shown throughout this lecture so far. But it's the underlying logic behind when and why they should work. Because once you can understand that, you can come to the conclusion of, all right, it's all about recognizing what's the current program that we're in. Are we currently in a sell or buy program? And once that's clear to you, you must know what's the draw liquidity, where's price reaching towards. Because once you know these variables, what will happen is that the market will seek to create these arrays. And when I say the market, I'm referring to IPTA, the interbank price delivery algorithm, for your info. But what will happen is that IPTA will seek to create these algorithmic signatures. They will be shown to you because what's happening is that IPTA is in a rush to reprice towards a specific level. An example of the bullish breaker can be seen here, where the market expanded towards the downside, formed this low, retraced higher, and then had this final expansion leg towards the downside, taking out sales liquidity resting below this low. Notice that the market then displaces above this upclose candle, above this high, which set up that final run lower, taking out sales liquidity, and therefore you anticipate that this upclose candle is likely going to function as support moving forward. Notice that when it comes to this delivery which takes place, you can also see that a bullish value gap formed throughout the run above this high. When we then pay attention to the bullish mitigation block, what you can see is that the bullish mitigation block forms when a bearish order block sets up a run lower, but does not take out sales liquidity followed by displacement higher, causing the bearish order block to become an inverse bearish order block. Price will seek to retrace into the price range of the bullish mitigation block before expanding higher. What you see inside this schematic is that the market expanded lower, forms this low, retraces, and we then see the market have one more drop lower, but notice that where the bullish breaker took out sales liquidity engineered below this low, you can see that the bullish mitigation block does not take out sales liquidity resting below this low. And therefore, the moment that we see this displacement leg above this high, it confirms to you that we have in fact formed the low, and now this final upclose candle, which set up this retracement leg, can get utilized as a potential buying opportunity throughout the next retracement leg. This is your bullish mitigation block, and this range can be utilized as a potential entry opportunity. When we pay attention to your chart example, what you can see is that the market expanded towards the downside very quickly. We formed this low, and below this low, sales liquidity is engineered. We see the market expand towards the upside, and we begin to see it retrace into the price range which formed throughout this expansion lower. Notice that the market has one more drop lower, and notice, however, that we do not see the market take out this low, meaning we see the market create a higher low. When the market then displaces above this upclose candle with this very strong close, we can anticipate that this upclose candle is likely going to function as support next. And from that moment in time, we can change our idea from bearish to bullish. Notice that this upclose candle does in fact function as support on price right here, before we see the market expand towards the buy side liquidity engineered above this high. When we then pay attention to that PD array matrix one more time, what you can see is that within this schematic, I've now replaced where the A and B are. Notice that A is now on the bottom left and B is on the top right. What you can see is that, just like I outlined with regards to the bearish example of the premium array creations, you can see that there's a sequence to the creation of the discount arrays. Therefore, your job is to investigate whether or not you're able to recognize this sequence. And understand that for many of you, watching this lecture at one go might not be good. And the reason why is because I discussed a lot, and I discussed a lot of different perspectives on concepts which you already got introduced to probably in the past. And therefore, you must investigate whether or not there's any validity behind the statements which I'm making throughout this lecture. Because at the end of the day, Your job is to see whether or not the validity is there behind that what I'm explaining to you. And the way you come to that conclusion is by going into your charts and investigating whether or not you're able to see these PD arrays. And when you start blending that with what I've discussed prior with regards to time and price cycles, it will already open up a completely different world for you when it comes to your perspective on the markets. And with that being said, this lecture comes to an end. I hope that this lecture has provided you with more insights on PD arrays, and I look forward to catching up to you in the next lecture of the 2025 model series. Good luck with your studies, and I invite you to go into the charts and test whether or not you're able to see this sequence again and again. Be safe, and I look forward to speaking to you in the next episode.